Thanks for joining us at XM.com. This is today's market comment by Mario Sechigriacos. I'm Cristina Marujas. Federal Reserve officials have been out in droves this week, highlighting the extraordinary strength of the U.S. economy and stressing that interest rates might need to be raised further to bring inflation back under control. This message was hammered home by Fed Chairman Powell yesterday, who stated that his central bank will not hesitate to tighten further if it becomes appropriate, adding that the Fed is not confident yet that it has achieved sufficiently restrictive policy to defeat inflation. Markets responded to these hawkish remarks in classic fashion. The dollar strengthened as U.S. bond yields zoomed higher, boosting the reserve currency's interest rate advantage. The focus now turns to next week's CPI inflation report, which will shape bets around the interest rate path. In the bigger picture, the question facing traders heading into next year is which central bank will cut rates first and how deep those cuts will be. That's a setup that favors the dollar, as the resilience of the U.S. economy suggests the Fed might be among the last ones to launch an easing campaign. Shares on Wall Street lost some ground yesterday, feeling the heat of rising yields. Powell's hawkish commentary managed to interrupt a winning streak of 8 consecutive sessions for U.S. stocks, with the S&P 500 getting rejected from near a downtrend line to close 0.8% lower and erase all its gains for the week. Over in the United Kingdom, a positive surprise in quarterly GDP data was not enough to lift the pound. The UK economy stagnated in the third quarter, overcoming forecasts pointing to a minor contraction. However, business investment fell off a cliff, which, in conjunction with gloomy business surveys, suggests that the worst is yet to come for the British economy. The strangest part of yesterday's session was that gold prices traded higher despite the negative pressure exerted by rising real yields and an appreciating U.S. dollar. It appears these negative forces for gold were overpowered by something even stronger, perhaps direct purchases by central banks raising their reserves. That said, gold prices are still headed for heavy weekly losses, and the root cause might be the absence of a material escalation in the Middle East. Thank you for watching today's market comment here at XM.com. Have a great weekend.